Good morning, good afternoon, wherever you're at, it doesn't matter. Good day today. I'm Sam with the Openshaw Real Estate Group, accompanied and partnered with none other than my very much older sister, Dana Firth with the Openshaw Real Estate Group. Dana, hello.
Hi, everybody.
Welcome. You'll notice that we have another stranger here. Not the greatest looking guy, but a really great guy. His name is Josh Jiron with Canopy Mortgage. Josh, welcome to the podcast.
Yeah, happy to be here.
You're basically talking to my mom and only my mom. She's the only one that really watches these.
Well,
podcasts.
I miss her, so I'm glad to hear.
Hi, Mom.
We'll
Thanks
let
for
Caitlin
listening.
know.
Yeah.
She'll
My
tune
wife
in
will
too.
watch.
Yeah.
Will she?
No.
Okay. Okay, I didn't think so. Didn't think so. All right, so let's jump right in because we're gonna kind of make this quick and sweet. But there's a lot of nuggets, and I think there's a lot of information that Josh can provide all of us in the real estate game, especially geared toward mortgages. Right? So let's jump right in. What do you?
Yeah.
You
Well, I was gonna say we can't do what we do without somebody like Josh.
Yeah.
Like buying a home, we can't. I mean, if you're cash, yes, but
Yeah.
without a banker.
Yeah.
So
And I think we'll go through some of that, why it's so important, and you'll learn, but why it's so important to have a good lender on your team. Right?
yes. Mhm.
So Josh, let's jump right in, right? First time home buyers, right? What's the benefit? How do you help them? How can you make them buy a home? Help them buy a home.
And what are some? Sorry, I
Yeah,
always
no,
interrupt you. I love
interrupt,
this.
yes.
And what are some common misconceptions for first-time home buyers?
Yes.
Well, the
Yes.
two biggest things that I battle when I'm speaking with a first-time home buyer is, first off, I want to make sure I'm educating them, right? Here's what the process looks like. Here's what qualifying looks like. But then to your point, there's also some misconceptions that I try to help steer them past and kind of illuminate the path to, hey, you can actually do this, right? You don't have to have 20% down saved to buy a house today. You don't
I think
have to have.
that's
Go
a
ahead.
huge value for Josh is
Yep.
teaching people,
Yeah.
right? Especially first time home buyers.
Right.
I think you're more confident in the process, then you're more confident at purchasing a home.
Sure.
Yep.
Then you learn the real estate game, then you learn how to be like an investor, and it's just a huge effect. But when you learn it, it's huge. It's something you can never get taken away from you. It's
Right.
knowledge, right? Okay, so back to the myths, right?
Well, just to that point, to add on to that, maybe the stigma or the intimidation factor that a lot of people understandably feel, I don't have, because I've been in home lending for over 20 years, and so it's something I'm so familiar with. So I try to use that comfortability to make it feel as achievable as it really is, and
Sure.
sometimes people don't understand that.
Yeah.
And so that's probably my favorite part of my job,
Yeah.
honestly, is to talk people through that, educate them, and help them understand that it's not this big scary thing.
Yeah,
Yes.
I mean, we sell so many houses a year, and we just do this all day, every day. That it's even good for us to help first-time home buyers sometimes, because it really, you got to take a step back and really dive deep into the process and really take them, step by step through
Yes.
everything. Where we're just throwing out stuff, and it's they don't know, right? So we
Right.
need to just educate.
And because we do this all day, every day, we can take for granted
100%.
that
Yes.
what it was like to be going through for the first time. So it's nice to kind of take a step back and put ourselves in that position.
What people maybe don't know.
Sure.
Because
Yeah.
we assume sometimes that people would know. And so talking about first-time home buyers too, oftentimes they're going to be coming direct from mom and dad's maybe, or wherever they lived, or be renters.
Right.
And how can you help renters? Because I know you've helped some of our clients recently that are renters, and they called on some of our rentals, and they ended up having a decent amount of money to put down, but didn't necessarily realize the benefits of buying and
Right.
all the savings that can come along with that.
Right. And the first step to generational wealth oftentimes is owning a home.
Yep.
So I do remind people of that as well. Now, as far as going back to the misconceptions, a lot of renters think, I don't have perfect 800 credit score. I don't have hundreds of thousands of dollars to put down. So something that's kind of like an abstract, like, sure, I'd like to buy down the line, but thankfully, if you have less to put down, you can still have access to competitive interest rates relatively low payments, and then also gain access to the tax benefits of owning a home
Yes.
to offset
Huge.
any potential increase in your housing payment going from renting to owning, because obviously renting you don't have all of, those tax benefits. So just talking through that transition and what that would look like for people, oftentimes they're surprised to learn that it's not a big jump or much of a jump at all in their actual month-to-month budget and finances.
So, like we've talked about in other podcasts, like some of the myths in either home buying or home selling. But like with the mortgage stuff, like what would pick like your top 3 that you hear so common? Because I think we've heard some that are so common over everybody that I'm sure you have some on the mortgage side that you hear as well. So like a myth about like down payment.
Sure, yeah. So again, I referenced it before. People think I don't have 20% to put down. And 20% is kind of a magic number in people's minds, rightfully so, because if you put 20% down, then you're kind of positioning yourself in a certain bucket of qualifying. That makes sense, but that doesn't mean that putting less down is impossible or gives you such an unattractive loan in terms of the rate and payment that it's not worth doing. That's thankfully not the case. We also have access to going on, I think, a half dozen down payment assistance programs for people that maybe, just the natural progression of their life, they've maybe gotten a recent promotion, so now their income is at another level, but they haven't had a runway of time to save up for even, 5% down, let's say. So a down payment assistance might be an attractive tool to buy a home now that they, can afford it, maybe on their month-to-month income, but they haven't saved up even a little bit for a down payment.
So does down payment assistance mean that you're gonna, like, not you, but the mortgage, the down payment is covered 100%?
Yes.
Okay.
There are different types of programs, different scenarios call for, whichever of those programs is the best fit. But yeah, I mean, there's basically a tool in place to make the down payment for a buyer. And then oftentimes those that assistance is forgivable depending on the program and the terms, but obviously those are something I would want to walk through with a client depending on what they're looking to do in their situation.
So you're going to look at the big picture and see what's going to be most advantageous. What's the least amount of money that somebody can put down on a home? Zero. So somebody could buy a home with zero down.
Well, and also just given the time we're talking now, 2025, it's a bona fide buyer's market. I'm sure you guys have talked about that maybe in other episodes of your lauded podcast. Thankful for having me here.
You're welcome.
But to your point, even if you are getting a down payment assistance that covers the down payment, there are other funds needed to be accounted for at closing costs, prepaids, and so being in a buyer's market where you have leverage, unlike a lot of times in this market especially, there's some negotiating to be taking place that maybe a seller is covering your closing costs. So you truly are coming, to closing with no money.
Close to no money or no money down. Okay.
And you can say whatever you have, you can use for moving expenses, furnishings, those types of things.
So I think that's a really cool segue into, we are in a buyer's market, like really truly when we look at the Cromford report right now. And so buyers have leverage because we've got a lot of inventory and maybe not as much demand. Now maybe that's factual. So we have an opportunity where sellers might be paying concessions. So we were talking about this the other day. What's a better opportunity for sellers? Or buyers, I'm sorry. Is it looking at getting closing cost concessions from the seller, or is it a reduction in price? And then if it is concessions, what do you do with that? Like, what are our options?
How do you determine what you do with it?
Sure. No, it's a great question. So
that's what we're here for.
You guys are great at this. So obviously I tell my clients, especially going through the process for the first time, of course we want to purchase the house for the lowest price we can, right? We want to get the best value. That's a given. Now you can pull that lever and try to get the price reduced if you're in position negotiating from a position of strength. But the other lever to pull that would probably move the needle more in terms of your projected monthly payment is seller concessions. Obviously we talked about their standard, closing costs of doing the transaction, and then what I refer to as prepaids, and I can get into that in a little more detail real quick if you'd like, but essentially those funds can be covered with those seller concessions,
Uh-huh.
but then additional seller concessions over and above that have to be applied to costs associated with the loan.
Okay.
And so essentially that would mean we're looking at buying the rate down.
Okay.
And depending on the interest rate environment and a few other factors, I usually talk through with clients either a permanent buy down
Okay.
to the rate or a temporary buy down.
Okay.
And
Difference?
so a permanent buy down is just like it sounds, right?
Okay.
If your rate is 6.5 at, no buy down, but we have X amount of dollars to play with, if we apply those excess dollars via those concessions to buying the rate down, that just simply brings the interest rate down, and that's the rate associated with the loan for as long as you have that loan.
Okay.
So if we have X amount of dollars, we can buy the rate down from 6.5 to 6.25, then there's the corresponding reduction in your monthly payment.
Okay.
Now, a temporary buy down comes in a lot of different flavors. It's a longer conversation than you want me to kind of drone on about, but the overall premise is for a set number of years, 1, 2, or 3, starting on the loan, you can have your payment discounted in that intro period a pretty significant amount, 1%, 2%, even 3%.
And it's incremental basically.
Exactly.
Year over year.
And it's temporary,
Uh-huh.
right? Like given the name. And there's other reasons why that could be a good fit. A time of elevated rates where we think rates are trending down in the future
Mhm.
could make that more attractive. Also depending on, if you're going from renting to buying, a lot of times, even on a mental level, it's something that helps buyers kind of feel like they can take this on. They're kind of easing into.
Get used to a payment over a period of
Right,
time. Okay.
exactly.
Okay.
And that's a period of a year at a time on the temporary buy down. So
Okay.
it's a good amount of runway borrowers are giving themselves to, again, adjust to their new normal, see the tax benefits and how that impacts their monthly budget really in effect as they kind of work through the, owning a home.
Okay. Okay.
I think that would be good for, I'm just thinking through, like a client who maybe late 20s, early 30s that are just started a really good career, but they just need a little help on the monthly payment, but they know in 3 years they're going to make, a substantial increase in
Sure.
Yeah.
salary or
Yeah.
whatever.
100%.
Or if we think
Bonuses.
interest rates are going to eventually start trickling down, yeah,
Mhm.
let's get a low one now, and hopefully in 3 years it's kind of gone down, and we do a refi.
Right, exactly. And to that point, a nice benefit of a temporary buy
This is
down
my favorite part.
is you're essentially guaranteeing you're not going to squander any bit of those seller concessions you've negotiated in this moment of time where we have that leverage to get those concessions.
Right.
Because if rates, this is not a bad thing, right? If rates drop faster than we project, right? We were thinking, maybe they'll come down in the next couple of years, right? You said 3 years.
Yeah.
But, the economy right now is unpredictable. Rates, could drop faster than that. All of a sudden, 6 months from now, we see rates drop. We're probably going to want to take advantage of that, refinance.
Mhm.
And when we refinance, we pay off the loan that we had in place to purchase the home. So thinking about a permanent buy down, if we bought the rate in my example down to 6.25, but now 6 months later, rates are 5.75, for example.
You've paid that money all up front for the permanent buy down.
Exactly.
Yeah.
And now you're replacing that loan, paying it off, putting a new loan in its place at that lower rate, because of course we're going to take advantage of that.
Yeah.
Sure.
But now you've eliminated the benefit you received via those seller concessions and the permanent
Yeah.
buy down because that loan is paid off and gone. Right?
Yes.
So you didn't really maximize the concessions in that
Yeah.
scenario.
Yes.
Whereas on a temporary buy down, like we talked about, you've got, let's say, the first 2 years where
Mhm.
you've got a severely discounted payment. What's happening in those 2 years is the temporary buy down funds were collected up front.
And then it's just drawn.
Exactly.
Right?
Then
Yeah.
every month, money's taken from that fund and applied to discounting your payment. And so, if you were to refinance and pay that loan off during the temporary buy down period, whatever sum of that temporary buy down fund has not been used will be applied to the payoff of that mortgage.
Mhm.
And so, you're going to have that money used one way or the other.
Yes.
There's not really an option, given what we can control, like
Yeah.
interest rates. There's not really an option to not use every penny of that money.
Yes.
And
That's one reason in particular why I love that temporary buy down option,
Mhm.
because you almost have like reserves,
Mhm.
right?
Yeah.
And then you don't ever really, you're not squandering it.
Exactly.
Yeah.
I mean, I like the idea of there's certain factors like the interest rate environment that we can't control.
Nope.
So if we are setting ourselves up to, if something happens in that area that we don't control, that we don't expect, or that happens faster than we expect, we can position ourselves to, maximize the concessions that you negotiated, right? You negotiated for your buyers, so it's a nice little safeguard, while also the real benefits of that significantly reduced payment.
Well, you talk about like when and if we get a lower interest rate, we'll just do a refi. No matter what type of program you're on. My question comes from no matter what type of program or interest rate. When do you suggest that they do a refi? So like if we're at 6.5 today, it drops to what? And you would say, hey, this is probably time to refi.
So it's a great question, and it depends on the specific scenario. The reason I say that is, depending on the size of the loan, an interest rate reduction is going to mean a different amount in terms of the reduction in monthly payment.
Right.
So if we're talking about reducing an interest rate by 0.5%, that sounds like a decent amount, and it is. But in terms of the dollars, if we're talking about a $200,000 loan versus an $800,000 loan, the difference in monthly savings for that reduction in rate is going to be varying quite a bit.
I got you.
While the closing costs associated with refinancing are similar, right? A lower loan amount is going to be slightly cheaper on closing costs, but in the same ballpark. So because that piece of the formula is pretty set for both those scenarios, but the monthly payment savings is different.
Yeah.
I would say it's kind of a case-by-case basis.
So they should reach out to you then.
Exactly. So
Okay.
I also keep a running list of clients who I'm watching rates for, because I think there's an opportunity in the next 6 to 24 months, let's say.
Okay.
But certainly I'm always available if people, peripherally you just hear, oh, I heard rates are down.
Yeah.
I love having those conversations and
Right, you
evaluating
can look
the
up
numbers.
real quick and say,
Yeah,
oh
absolutely.
yeah, they're here.
And the formula I run usually is reduction in monthly payment versus the dollars that we're estimating for costs, and then how many months of monthly payment savings will it take you to recoup those costs before it's pure savings after that. So we kind of just talk through that.
So the higher the loan amount, the smaller like the interest rate that you would refi, because you're gonna have a bigger dollar amount on your monthly
I think
payment.
that's probably it.
Then the lower loan amount, you need a higher reduction in interest rate to get like the same like dollar amount of
Yeah,
funds.
that's a fair way to put it.
Makes sense. Yeah.
I mean, they're comparable, right? It's not a
Sure.
vast valley, but like there could be a little differences in that. Yeah.
Right. No, it totally makes sense.
And you can facilitate refis for people. Like if they call and say, hey Josh, help me out.
Absolutely.
One thing too to consider, and I know that you do this because you've done it with some of my clients before, is when they want to go and do a refi, we also need to find out like how much time they think they're going to spend in that house. Like,
For sure.
If they have 4 kids and they're all going to be graduating high school in the next 3 years, normally it takes about 3 years to recoup kind of those down payment costs, the closing costs on that refi.
Sure.
So maybe you're like, maybe you don't want to spend that money if you know you're going to move in the next 3 to 4 years.
Sure.
Maybe not do it.
Or to your point, sometimes we talk through a no-cost refinance, where we say, okay, maybe the rate is slightly higher than the 0 points refinance where we absorb the standard title fee closing costs.
Okay.
But if we're going to be in the home longer term, we probably want to take the lower rate and lower payment because we'll have more time to recoup those costs and then have pure savings.
Yeah.
But to your point, if we're on a specific timeline, then I'm going to look at options where we minimize or eliminate closing costs, even if it means that the reduction in payment is lessened a bit.
So at the end of the day, what I hear you saying is you're not going to encourage somebody to refi if it doesn't make sense.
Of course.
Yeah.
Yes.
100%.
Yeah. Love
Client's
it.
interests always come first.
Absolutely.
No, that's
Yeah.
that's the way we operate.
That's why
Absolutely.
you're part of our team.
Well,
Yes.
and I want to do right by everybody I work with.
Yeah.
And hopefully that means I earn a client for life.
Yeah.
Well, it's pretty factual. Like you can print out or email or even do a Zoom call and show them the numbers and say,
Right.
this is if we do this, this is if we do that.
Yeah.
What
And now
do
you're
you-
speaking
what do
my
you want,
language. I
right?
mean, once we dive into numbers, I'm like a kid in a candy store.
Oh,
Right?
he
It's my
will.
favorite.
We've got scenarios for days sometimes. We're like, show us all the different things. And he's got it out down to it. I mean, everything and laid out. It's so informative for our clients. So at the end of the day, they can make the best
They
decision.
make the decision.
Yeah.
Yeah.
We just
Yeah.
facilitate and show them options.
Yeah.
Right?
Exactly.
I love it.
So while we're still talking about like first time home buyers and stuff, and we talked about the interest rate, and I think we beat that up, but we only have a few minutes. But
Sure.
what about like gift letters,
Mm-hmm.
right? To help a first-time home buyer get into a
a
new
good question.
home,
Mm-hmm.
like what does the gift letter do? What does it entail? Why would one person choose to do it or not?
So that's I was going to bring that up when you talked about misconceptions.
Right.
There are options to bring the down payment in from a gift,
Okay.
whether it be a relative, a close family, friend, etc., depending on the type of loan, and we can talk about that with the client, of course. But if you have grandma, mom, dad, say, hey, sure, I'll cover part or all of your down payment. I want to help you guys get into this house, what have you. Maybe it's a young family. I mean, I see that all the time.
Sure.
That is allowed. Right? Really, every program allows for that.
Is it like difficult to do?
There's really nothing to it short of simple. Let's just say it's mom and dad.
Right.
They want to provide your $15,000 down payment. They simply, once we're under contract, send a wire to the title company of those funds, and then literally there's a pre-formed letter. We just fill in a couple blanks. They sign it. That's it.
So it should be wired directly,
Yes.
not in different increments via a Cash App.
Correct.
Yes.
Or
okay.
and also you want to make it. My goal is to make every transaction as painless as
Yes.
possible, and so
And easy to source.
yes. So technically, a gift donor could give the funds directly to our buyer, but that creates a lot of trouble for everybody. More documentation, and so in the interest of keeping it as painless as possible, funds directly from the gift giver to title make it very
Beautiful.
clean and easy.
Okay.
100%.
Love
But
it.
that is a very common, and
Mhm.
even in this type of market for parents or
Yeah.
anybody
Uh-huh.
Yeah.
to help out. Do you have to be related?
Yes,
You do. Okay.
but there also is some nuance there, I will say.
Okay.
So let's just say that's worth a conversation with
Okay.
a
Call
client.
Josh. Sorry, man.
Okay.
I
No, you're
stumped
good.
him though.
I know.
Stumped him.
Well, just in lending there's some gray areas, so I
Yeah.
want to make sure I explain it properly so everybody's educated. But it's
There's
case
a lot
by
of gray
case.
areas, Josh.
Yeah, well-
There's a lot of gray areas.
And so none of us can
You're
have a
working
beautiful
on it right
moment,
now.
okay?
That's God.
I know. On this topic, though, I do want to mention that for veterans, there are VA loan options where we don't have to worry about being required to make any sort of down payment. They'll just simply finance you to 100% of the purchase price.
Right.
USDA loans for rural properties also allow for 100% financing.
Yep.
So even, on those kind of specified programs that aren't necessarily for everybody or every property, they're prevalent enough to where they bear mentioning.
I love it.
And I think now that you mentioned the VA, I just want to touch real quick. VA is a little more. I want to use the word complicated to figure out, but I'm not a lender guy, right?
Mhm.
So I think if you are or did serve in the military and you were able to do that,
Mhm.
that is definitely a conversation that you need to have with Josh because, like you said, there is zero money down. You get better interest rate. There's all kinds of different perks and
Yes.
benefits to a VA, which I totally agree they should
I
get.
love a VA buyer.
Yes.
And I encourage my sellers too, and my sellers, not encourage, but I have a discussion with my sellers because I think there's another misconception about VA loans because
Yes.
there's different things that come along with it.
Yes.
And I explain to my sellers what strong buyers our VA buyers are, and that
Right.
they have an opportunity to support, somebody
and-
who has served.
Since you mentioned that too, I do want to mention along those lines, thinking from the standpoint of a seller,
Yeah.
VA, FHA,
Mhm.
they can kind of have a little bit of a stigma attached
Yes,
to them. But
Sure.
from a
unfortunately.
lender's perspective, while they allow for zero down or a minimal amount down, I would argue they're the easiest loan for a borrower to qualify for. And so in that regard, if you're thinking from a seller standpoint, I want to accept an offer that's going to, have the least amount of landmines potentially.
Sure.
Uh-huh.
A loan that has a lower threshold to qualify for is what you're looking for, and that's what FHA and VA allow for.
I love it.
Well, okay, so another thing, we talked about interest rates, we talked about gift letters. I'm hearing a lot of, but I have a 2.5 or I have a 3%, I have a 3.5, I don't want to sell, I don't want to give that up.
Uh-huh.
Sure.
So I want to talk about a home equity line of credit, which
Mhm.
is a HELOC.
Mm-hmm.
So let's say you have a ton of equity, you got the 2.5%, you don't want to move, but it might not be financially the best option to move.
You don't want to move, but you do.
But you do
Yeah.
want to. Yes,
Yeah.
thank you for.
Well,
thank you for saying.
I'm seeing it a lot, right? Life still happens. Even
Yes.
though people understandably want to hold on to their historically low rate we had a few years ago.
Right.
Life happens. You have more babies, you need more space, or you become
Less.
an empty nester and you want to downsize.
Yeah.
So those natural progressions are going to happen
Right.
whether we have a low rate or not.
Right.
So to your point, I have helped clients take out a home equity line of credit to access a portion of the equity in this home, hang on to it, right? So you're not letting go of that historically low rate, maybe turn it into an investment property rental
100%.
that'll likely cash flow because of that low interest rate and the fact that rents have continued to kind of slowly trend up over time, and still make that move while not sacrificing that low rate.
Right.
They can hold on to it.
Mhm.
Now we've got an income property.
Right.
And now we have cash to put down on our new home
Mhm.
that better suits our needs or our time of life where we're at,
Right. And
location, whatever.
And the nice thing about that kind of scenario too is an underwriter will give you credit for 75% of the projected rents for the home you're moving out of. So
Okay.
you don't have to qualify for 2 full
Okay,
housing
so you
payments.
only, so it's essentially 25% would be counting towards your DTI, 25% of that mortgage
Sort of.
on
So
the
that-
origination,
well,
the
in this
originating property.
in this scenario though,
Okay.
because we're probably projecting a cash flow situation because the mortgage payment is low because of that low rate,
Uh-huh,
it's 75% of the gross rent. So for an example, let's
Okay.
say the mortgage payment is $2,000 a month on that low rate loan, but the
Uh-huh.
home rents for $3,000 a month.
ah,
So it's 75% of that 3,000
okay,
capped at negating the payment
okay,
on in that exact scenario.
Okay.
Right? So they wouldn't give us credit for overage in terms
Overage.
of positive cash
but it
flow.
would almost negate your payment,
It could negate or
Okay.
negate a lot, if not all of it,
okay,
and then you're not forced to qualify for both payments moving forward in
Okay.
terms of our debt to income calculation. So it's nice that they allow for that with a pretty minimal amount of documentation.
so what I hear you saying is it's worth a conversation,
Absolutely,
okay,
yes.
Because it might not count toward your debt to income ratio.
Yeah.
Right, because
You
I
might be able to
can
make it
hear
happen.
kind of light bulbs going off as people hear us talk about this, like, well, that's all fine and good, but I can't afford 2 payments. So
Yeah.
this is a way that they allow for us to avoid that essentially on
Brilliant.
paper.
okay.
Couple little small questions and spend like 30 seconds on them.
Sure.
I've heard a rumor, don't know, you're a lender guy, like student loans, does that count toward debt to income?
It does. Now, thankfully, when I'm evaluating a client and I'm looking at their debts on their credit report, there are different types of debts that affect debt to income differently, right? All we are looking at as a lender is what is the required minimum payment. So while I would say, none of us want credit card debt, for my purposes, that's not the worst thing in the world necessarily because we're only factoring in the minimum required payment.
Okay.
So student loans, if they are deferred, which pretty much all have been, now they're starting to come back online with monthly payments, but the payments are pretty minimal that are being required to be made compared to the amount owed. So it's like, for example, if somebody owed that same amount but it was on an auto loan, it's a pretty safe bet that payment's going to be quite a bit higher comparatively. So student loans are not a huge barrier to buying a home generally.
Okay.
What advice would you give any buyer, first time or not, that has like a 401k but maybe not a ton of cash, liquid cash in the bank account? Like, what would you say to those people that want to buy a home? Can you use that money? What does that look like?
So it's a great question. I would evaluate what the projected purchase looks like without tapping into those funds first, right?
Sure, because you'd
Because-
rather keep it in there. and
Correct,
keep it-
yeah.
Okay.
But another nice perk that guidelines allow for specifically to retirement accounts is they will allow you to borrow against it as opposed to withdrawing, right? If you're withdrawing, you're incurring penalties, taxes, etc.
Yeah.
So we want to avoid that if we can. But if you take a loan out against a portion of your retirement account, we actually don't have to count whatever the payment is on that
Right.
towards your debt to income calculation.
Oh, there you go.
It's looked at as essentially borrowing from yourself,
Right.
so it doesn't factor into the debt to income formula. So that gives us flexibility of potential access to funds for a down payment to purchase a home
Yeah.
And I've never done it myself, but from what I hear from clients, you get pretty favorable terms on that kind of setup as well, and you're paying yourself back.
Yeah.
Yeah.
I want to know, I've got a question. What is the lowest interest rate that you have secured for a client recently with concessions, whether it's a temp or a permanent buy down
So
In 2025.
in 2025?
So I'll answer both questions. On a permanent buy down,
Okay.
I've gotten down to the low 5s.
Love it.
And
That's exciting.
yeah, a temporary buy down, I've gotten down into the low 4s, right?
Okay.
Because for those initial,
Like a
Okay.
3-2-1,
yeah, exactly.
So when we hear people saying they want to wait for interest rates to go down, what I'm hearing you say is we've had the ability to make them go down by how we negotiate for our buyers.
100%.
Okay.
There's
And
options.
I myself, my family and I, we bought a home about 6 months ago. That's
Yeah.
how strongly I believe in this market for buyers.
Okay.
And I did exactly what we talked about. I had a home with a historically low rate. I converted that to a rental property. Blessed to be cash flowing that.
Uh-huh.
Now we have this other home where we were able to get the rate down because of
Yeah.
concessions, and so it's very doable. I can't give it any higher endorsement than I thought it was best for my family
Okay.
personally. So
Right.
that's how strongly I believe in the opportunities that are out there because it's fleeting. It's not going to be
Yeah.
here forever.
I love that.
Well, that like to me kind of means a lot. Like when you have somebody that actually like talks the talk
Yeah.
and walks the walk, right? Like we'll do that too. Like clients are like, well, I don't know if I really want to sell, or I don't know if I really want to buy right now. And
Yeah.
Me and Dana are taking down a big resort, a huge investment property right now. Like in this market that the news just says is just so ungodly,
Yeah.
and the world is ending, and
Right.
things are gonna blow up, right? Like no, we're still doing transactions.
There's so many cool opportunities to be had right now.
For sure.
There's always a
Yes.
need for real estate. There's
Mhm.
like really it's just working with the right people,
Mhm.
right?
Yeah.
To make sure that you've got people looking out for you that are knowledgeable, that truly have your best interest at heart
Right.
and can make this happen for you.
And to your point, that we'll be upfront and honest and say,
Yeah.
hey, this probably isn't the property for
Yeah.
you. The seller's not where they should
Yeah.
be, or whatever the case might
Yeah.
be. It's not
Yeah.
about
It's not
you
about
gotta
us.
get this deal. It's just does this check your boxes, meet your goals,
Yeah.
etc. So
Yeah.
that's what we're focused on.
Super cool.
So we'll give Josh an opportunity to kind of close us out, and
Okay.
then me and you will kind of let's do like why it's important to have a very good lender partner on your team,
Oh, I'm good at this.
whether it's Josh or not. So we're not pumping your brake, dude. We're not pumping your head up. But why would like a good mortgage person be
Yeah.
beneficial for a buyer on our team? But Josh, like if to close us out, if there's something that we didn't ask or say that you wanted like the general public, how can you change their world and have them call you?
So I would say make sure you are connected with a mortgage lender that you trust. That's first and foremost. It is a big, transaction, a big step in life. So make sure you're working with somebody who has your best interest at heart, who's being upfront and honest, and educating you on the process and what your options look like. Myself, I'm fortunate enough to be with a mortgage banking company, which I would argue is the ideal lending partner for clients. The reason I say that is we have the ability to act as a broker in the initial steps of the loan, shop around for our clients with our dozens of investors, find the best rate and terms for that specific scenario.
Mhm.
I'm not married to any of the investors. I just care about what's the best terms for the client.
Right.
Then the reason I say best of both worlds is once we're active, unlike most brokers, every step of the loan process is handled in-house by members of my team. So processing to underwriting, getting our formal approval, getting through underwriting, final closing docs and funding. We have control over all of that to the finish line, and that allows us to meet quicker timelines if needed.
Mhm.
If there's exceptions that need to be made that are reasonable, we can fight for those. Everybody's pulling in the same direction,
Mhm.
so it really makes for a cohesive, smooth process. Whereas coming from the broker world for 18 years, I was at the mercy a lot of times of submitting a file to a whole nother company who has no loyalty to me.
Yeah.
They're looking for reasons to turn down my files oftentimes, and so that led to some spirited conversations that thankfully I was able to, persuade more often than not, but it's not super fun. You want it to be smooth and easy, and if there's
Right.
a question, you come to me like, hey, how do we get this solved? What's the answer here? And so, very fortunate to be where I am now.
That's awesome.
I love it.
Awesome.
He stole what I was gonna say.
He did sell a few of
Because
them.
that's really what I was gonna
We would have said it much
Yeah.
better too.
Yeah, absolutely.
Yeah.
So when we talk about the benefit to having Josh as part of our team, right? He's, We love working with lenders that we have experience with and title companies saying, but at the end of the day, we're not married to you. Like, I don't have any skin in the game if my clients use you. What I know is that my clients are going to get really good service, that they're going to have somebody that's shopping around for the best rates for them, that we know where it is in the process every step of the way.
I sure went first. Like
she's nailing this.
I can turn around. This is what I tell my clients. I can turn around, and I do it often. Josh, I've got Sharon on the phone, and I ask you a question because you're right there. So we give people options with lenders. We give people options with title. We give people options with inspectors. Like, right? That's what we have to do. People have options, and I don't get anything from Josh being my client's lender outside of the fact that I know they're going to have a really good experience and great service, and they're going to be happy at the end of the day. So, all of those things that you talked about. Yeah, I love having you as part of our team.
I like, and not to discredit any other lenders out there, right? There's probably some fantastic ones,
Absolutely.
but I just want to put that out.
I've learned from them.
Yeah, there are. So it's not just Josh is the only one; he's the best.
No, because you have other people at Canopy too. It's not 100%. Just Josh is not just Canopy, right?
Yeah.
Well.
I might like Matt a little bit better than you. I'm just kidding.
Love
I like you
Matt.
better.
A little bit better. Yeah. Things that I consider very valuable to have like a good lender on the team would be the communication factor. Not only
I said that.
Yeah, but not only to us, but even to like our clients. And Josh explained it at the very beginning. The first-time home buyers is educating those people. Educating first-time home buyers on that process and what to expect and how it all goes. That's huge. I like it because you call like a large bank institution, right? Good luck getting them on Saturday morning.
Yeah.
Right? Good luck getting them on Sunday night when the thing's supposed to close Monday morning.
Good luck getting them to close on time.
Or on time, right? Thing with Josh is one, Dana mentioned it, he's literally like sits just down the road from us.
Yeah.
Road meaning like 3 desks down.
Yeah.
I also know where this guy lives.
Oh boy.
He answers the call at 8 o'clock at night if I need it. You need somebody like that. He can also get the best rates, best terms and stuff for you. He's a great guy.
Yeah, I love it.
Great guy.
If I may, let me just pump you guys up a little bit, because I mean this genuinely. 20 plus years of lending. I've worked with many agents, and unfortunately there's too many agents that don't do a good job, don't have their clients' best interests, or looking out for their paychecks first and foremost, and it bleeds through. And it's unfortunate because that's not the business we signed up for. But your team is amazing. I'm very grateful that we work together so closely, and I know you do it the right way, and you know what you're doing. So just a wonderful crew of people. I love y'all.
Yes.
So Jamie will put Josh's information, on the links and stuff. But Josh, shout it out, like your phone number, your email, your personal address, your bank account,
list of fears.
Your kids' names.
Yeah, but honestly, like,
He's got a dog named Chowder.
Does he?
Yes.
I just know his wife makes cookies. She's a beautiful woman, and she makes the best.
Makes beautiful cookies.
We love
cake.
your
beautiful
family.
person.
Okay. Anyway, how does somebody get a hold of you, Josh?
Am I giving contact info? Or
give contact info, but James gonna put it in there for us.
Okay, it's my direct number. You can call or text me at is 480-581-1247.
Okay.
You can email me at J, like Josh, J, and then my last name, I'll spell it JIRON at canopymortgage.com.
There you go.
I'm available pretty much 24/7. My wife does not love that. I'm sorry, love.
I like the 2 a.m. call.
It's the business we're in.
It is the business we're in, and I just want to do the best job I can for clients.
I love it.
So.
Sure.
And you do.
Any questions or comments, reach out, and even for Josh or for us on real estate. From Sam, Dana, Josh, we love you guys. We thank you guys. Let us know how we can be of service.
Love it.